Hello, hello. Happy Wednesday, everyone. Dave Hall here. Welcome back. You may notice a big difference. Today, CR Talene is out. He is in Texas. Those that attended with us last week or with us last week, you know that he went to Texas to take his son who's looking at colleges there. Today, we've got a unique opportunity for you. I've got one of my good friends, another advisor that I work with, Brian Britt, here with me. Brian, how are you?
Good morning, Dave. How are you?
I'm doing good. The snow has finally melted in Tennessee, so I feel like life can go back to normal finally.
I can't relate because I'm in San Diego, but I feel for you.
Yeah, well, at least shed a tear or something for me over there to make me feel like there's some compassion in that statement of having 60, 70, 80-degree weather all year long.
Well, it's actually really cold this morning. It's about 62 and sunny. So I have a jacket ready for when I go out later.
Yeah, I joke all the time that I'm ready to move back to Puerto Rico after having been there for 5 years. The lowest temperature we ever got during the winter was 60 degrees.
Yeah.
And then last week when we got bombarded with about 8 inches of snow, it definitely became a whole new world for me again, feeling like I was back in Utah.
Absolutely.
Brian, I'd like to let you talk a little bit about who you are. As I mentioned, he's a good friend of mine. We've been working together for quite some time now. Why don't you tell the listeners a little bit more about yourself? And as he does, if you've got questions out there that either of us can answer during the show today, please make sure you put those in the chat box. We'll be happy to answer those and address any issues that you have as you look to your safe and secure retirement.
Great. Well, it's good to be with you this morning, Dave, and good morning, everybody across the country. Great to have you guys with us. So just a little bit of kind of a background story about me and how I got involved in this business. So I started as a financial advisor on the East Coast in New York City about 33 years ago. And I know what you're thinking. I must have been 10 when I started. But I did begin on the East Coast, which is where I'm from, born and raised in Staten Island, New York. Known for the tallest landfill on the East Coast. That's what we're famous for, is the biggest garbage dump. But anyway, so I started in the business really just helping teachers from the Archdiocese of New York with their 403B accounts. And mostly back then, it was just mutual funds inside of a 403B account. And I worked for a mutual fund company at the time and was able to help those folks with their 403Bs. I then moved to Chicago and joined Lehman Brothers and really became a large cap value specialist for them. Started running a large portfolio for private wealth clients. Took that business, went to Paine Webber for about 5 more years, and then spent 11 years at Merrill Lynch. And what I noticed in my practice is a change in the conversation with my clients. So I actually have a client who's been with me for 33 years, and I have a lot of clients with me for north of 30. So a lot of the people I started with are still with me. But what the shift was in the conversation, up until maybe 15 years ago, people, when I got on the phone with them, they wanted to know how much money I made them. They wanted to know how the stock market was doing, how much their account went up compared to the stock market. What did I think the stock market was going to do in the next 6 to 12 months? Which companies did I like? Which companies should we get rid of? So that was pretty much for most of my career, the conversation. So, and what I realized is everybody was in the accumulation mode. They were all trying to just build these mountains of money. And about 15 years ago, I continued to start seeing the shift of people really changing the conversation from how much money did you make me to when am I going to be able to stop working, be able to take a monthly income? And if I do that and I live to 90 or 100 years old, how much is going to be left for my kids and my grandkids? And it was really a shift that seemed to happen all at once. But then I realized a lot of my clients were very similar in age. So it wasn't that coincidental, because these people were all getting to that point where they were like, hey, I've accumulated a ton of money. You know, maybe they consider themselves wealthy, but then they still, no matter how much wealth they had, they couldn't figure out that equation of how much they could really spend after taxes and including inflation and including potential healthcare crisis that they'd seen family members go through and how much that cost. They couldn't figure all that out. on their own, or even if they could, even if they were financial professionals like a lot of people on the phone today, they wanted someone to verify that information. They wanted to make sure that they weren't missing anything. So about 15 years ago, my practice really shifted. I was at Merrill at the time and really started to focus on financial planning, tax mitigation, principal protection, long-term care planning, estate planning through attorneys. And that really was a big shift. So when Dave and I started working together, it was just such a perfect fit because we both really look at the world the same. We want to protect the client's assets. We want to really deal with what we think might happen to taxes. That's the big wild card in this whole game. Kind of like, playing a chess match, and in the middle of the game, they change all the rules. And that's really what we're concerned about as advisors, is that our clients are going to think they're all set for retirement. And then somebody's going to flip a switch and say, actually, you dramatically underestimated how much the federal government and the state governments are going to be taking out of your clients' monthly paychecks. So that's kind of just a little evolution of how I got to where we are today. And just glad to be working with Dave and, being able to, like I said, work with someone that has a very similar worldview when it comes to financial matters.
Well, thank you very much, Brian. It's nice to have you here. And for those who are listening and watching the show, please put your questions in the chat box. We want to give you a chance to take advantage of the knowledge you have. You've got two experts here that are focused on helping you get through retirement. And for those of you that have maybe been on my webinar, you've maybe heard me tell this story. As we look at this tax situation, Brian, I often talk about someone going into a bank. If you were to go into a bank, you need a $100,000 loan to put into your house. You want to remodel your house, you go in, you get a $100,000 loan, and the banker comes out and says, we're more than happy to give you that loan, Ryan, but we're not going to tell you what the interest rate is. Mm-hmm. You come back to us in 10 years, we'll have figured out what the interest rate is, and you go ahead and pay off that amount of money. Well, nobody on this show, nobody in any of my webinars would ever take that. But you're right. That's exactly what we're doing with the IRS. We're taking that business partner we have, and we're saying, look, we don't care what happens in the future. We'll go ahead and take the risk that you're going to take as much or as little as you choose to take out of our retirement assets.
Absolutely. And I think that's a great story that you just told. We always call that the rich uncle story, who says he's going to make you a loan, but he won't tell you how much you're going to owe him at the end. But you just said it perfectly. And I think that's really the wild card at this point, is a lot of people can't imagine taxes being anywhere near even the average of what they've been for the last 100 years, because we're so used to low tax rates, right? So right now we're at the third lowest tax rate, I think, in 85 years. And most of us grew up in a time where taxes continued to go down. Right. So I remember in the 1970s, and all of you guys out there might remember 1974 is when ERISA was invented. It's when the IRA came out. 401ks, I think, came out in 78, and they were implemented right around 1981 by corporations. But if you think back in the 1970s, tax rates for that entire decade plus 2 years were 70% for the top bracket. So just imagine right now, the top bracket, I think a couple has to make like $600,000+ to be at 37%. In the 1970s, whatever the top income bracket was, whatever the top income was required to meet the top bracket, you were at 70%. And, a lot of people don't remember that, because again, we all grew up in a time where we were always taught to postpone as much of our tax obligations as we could, with the idea in mind that when we went to take that money out, we'd be in a lower tax bracket. And while that a lot of times could be true because your income is less, the reason it really works so well for, let's say, my dad, is because not only was his income a little bit less when he retired, it wasn't that much less, but it was a little bit less, but tax rates cratered. So I remember in 1974, my dad made $157,000 or something like that. I think it was closer to 160. And that was a major accomplishment for a guy that never graduated from high school and got his GED on a Navy ship during the Korean War. So I was pretty proud of my dad, still am. And he basically at that point said, I think he was more proud that he was in the 70% bracket than what he actually made. Like he was like, I'm in a 70% bracket. Like that was a badge of honor that you were in the 70 bracket. And I remember growing up that people would kind of brag about what tax brackets they were in. They wouldn't really say how much they made. They'd be like, yeah, I'm in a 70 this year. And everybody go, whoa, you're in a 70. But we look at those numbers today and we don't remember. And that wasn't very long ago that 70% was a reality. And here we are today. You could make $10 million this year and you're only going to be in the 37% bracket. And if you look at that math, right, every 24 hours, we have 10,000 baby boomers hitting age 65. So they're leaving the workforce, maybe. Some of them can't because they didn't plan, but hopefully they can. And they're also qualifying for Medicare, right? So we have these huge expenses that we've never seen before with a group that was so much bigger than its demographic group before, right? So you had these boomers, almost 80 million. The group before them was only about 52 million. So you have 80 million or 78 million people coming through the belly of the snake, as we call it. And the government, all they keep doing is just printing more money and borrowing more money and coming up with more reasons that they have to throw out another $2 or $3 trillion to stimulate the economy. So I think right now it's really timely that all of us as professionals are not just looking at principal protection and how we can do a good job for our clients. It's more about the tax game, because that's the game changer for everybody.
It is amazing how things have changed over time, because I've not had any clients come in over the last 10 to 15 years bragging about the bracket they were in. They were always coming in complaining that they were definitely paying too much money.
Yeah,
we do have a question here from one of the listeners. Let me go ahead and pop this up. It's from Bruce and Karen. My daughter, a CPA, took one of your classes, and she learned that my husband, who is 66, could draw on my Social Security now, and when he turns 70, could switch and claim on his own Social Security. This seems crazy to us, and we're not sure how to or if we should try it. I'm 63. Bruce and Karen, thank you for sending the message in here. Let me answer this. I'll answer this question from the Social Security side. A couple of things to know here. One, unfortunately, because of your age, you're not going to be able to qualify to do this. The rules regarding this are what is called the restricted application. So if both of you had been born prior to January 2nd, 1954, you would be able to qualify for the rules under restricted application. And what that would mean is that if you were both at full retirement age and you decide to claim early, your husband would then be able to file a restricted application, take spousal benefits on your side, allow his benefits to continue to grow up until age 70, and then be able to transition over. But unfortunately, you both had to have been born before then, because once we get into Social Security rules, what we have is deemed filing. So because you're young enough, you haven't filed those benefits yet, you're not going to be able to take advantage of what's being done here. So hopefully that helps answer your question. If you have follow-up questions to this, please let me know. Happy to answer any questions that I can to help you better understand how to maximize that Social Security.
And Dave, what was that date again? 1954. Was it June?
January 2nd. So the IRS deems you to be born a day earlier than you are. So if you have any benefits through Social Security, Medicare, when you look at your birth date, if you're born on the 1st, it's as if you were born on the 31st. So you're deemed to have reached that age the night before. It's the only point on the calendar it happens, but every 1st of the month, if you were born on that date, then it's deemed as if you were born in the previous year. So that's why they've got that strange January 2nd date, where most things you would say, hey, January 1st, if you had to have been born before then, if your birthday wasn't for the 31st, it's all over.
This could be one of the reasons the tax code is so thick. Yes.
Yes, it is. And yeah, same with Social Security. I mean, when we do analysis on these Social Security calculations, what we find is that there's oftentimes 10 to 20,000 different scenarios that we can use through our computer software to figure out what's the best date for people to claim. So it's definitely a big issue and a big concern that we have out there. Want to also post this from Jeff. Jeff checking in from Florida. Hello, Jeff. Good to see you again. Another planner that we work with. He was on the show a couple of months ago. Good to have you back with us today. So Brian, let's talk a little bit too about some these other risks. As a retirement risk consultant, it's my job to help people eliminate the various risks. You do the same as an advisor in your capacity, and one of the things that helps us work so well together. Another big issue that we seem to have out there is longevity. Seems that people are not projecting out the length of how long they're going to live. You want to talk a little bit about why that's becoming such a big concern for so many people?
Sure. I think the biggest issue today, thanks to, I think, modern medicine, more awareness of good health practices, more awareness of diet, exercise, and whatnot. We're just seeing people obviously live longer and longer. And, when you think about our parents and our grandparents, when I was teaching my classes over at UCSD for about 5 years at the business school, I'm trying to think of the slide because since Corona, I haven't taught the class and I might screw up my data on the slide, but it showed basically that, for example, when Social Security was invented, I think it was 1935 or something, when Social Security was invented, the average lifespan for a male and a female couple was like 57 years old, which is almost impossible for any of us to believe. The way Social Security was really designed is that you were supposed to be dead before you even qualified for Social Security, right? Because I think initially you had to be, I think it was 65 to get
65, yeah.
And then they lowered it now it's 62 technically, right? You can get it at 60. Not that we ever recommend that. Usually we don't, but so you think about that life expectancy, and then today you look at an average couple, and I think the average couple's life expectancy is north of 80. So that was, first of all, when they invented Social Security, I'm sure the people that invented it never in a million years thought they would be off on their lifespan calculation by over 20 years. So that's a heck of a lot of obligation for this country to have to pay out. Being that they, I think, again, didn't count on that. So we're certainly seeing a lot of people that, even as you and I present plans, personal financial plans to CPAs and business owners all over the country, we're finding that they're running out of money. And sometimes, and I don't know if you've noticed it lately, but even in all three scenarios, Scenario 1, where taxes never go up again for the rest of their life. Scenario 2, where taxes double. Scenario 3, where we do everything that we can do with our magic wands. We're still, some cases you and I've had in the last couple of weeks where all three of those scenarios, they still ran out of money. Now, the good news is if we do our magic wand thing, they don't tend to run out of money. The ones I remember from like even yesterday till they were like 94. Okay, so I don't remember getting fired by a 94-year-old because they ran out of money. So that's something that's not going to keep me awake at night. But at the same time, we're definitely seeing a lot of people really, I think, but I noticed two shifts. Number one, people are comfortable when we build out blueprints, making them go to 100 years old. So I think in the old days, that would have been pointless for someone to build a financial plan showing a lifespan of 100. Now all of our plans are at 100. And I think the moral of the story is the sooner we can get our clients to start making changes, to start shifting pieces around the chessboard in this game we're playing against the federal government, the sooner we can do that, the more likely we can get them to a point where in that optimal blueprint, they never run out of money.
Yeah, absolutely. That's one of the great things about what we do is we can take those risks off the table. One of the biggest challenges you have, and you need to understand too, what the government tells you is life expectancy is not what life expectancy is. And why do I say that? Because when we look at the government calculations, especially from a Social Security standpoint, when they're trying to calculate those benefits or any other program the government does, they set it right around 78 to 79. But that's because they're taking in infant mortality, they're taking in deaths that happen during your working years. Once you get to retirement, all that's off the table. So instead of having a life projection of 78, 79, now for a male, it's 84. For a female, it's 88, and that's average. 25% chance you're going to live past 90, 10% chance you're going to live into past 100. So one of the things I would tell everyone is make sure when you're looking at these projections, like Brian says, we see people running out of money all the time. You need to project for a longer life. We don't have people coming back from the other side and saying, guys, I can't believe that you missed that. I can't believe that I ended up waiting so long. If I would have taken that money earlier, I could have had such a better retirement. But we have people all the time in our office that are in their 80s and 90s that didn't plan to live that long that now are having some issues. So be aware that we want to extend that out as far as we can. I do want to make one comment back to Karen on your question. Hopefully you're still on here. Karen, why don't you send me an email? If you would, I'm going to give you my email address about this Social Security question because I would like to talk to you a little more about it. The assumption I made when I gave you the answer is that you would not start claiming this early into the process, which you may be in a situation where you've got to or you're choosing to. Generally, we would want you to wait longer than age 63. But if you'll send me an email at dave@theprosperityguy.com, I'll happily get into a further communication with you and see if there is some way that we could possibly make this work for you if you've decided that you are going to start claiming those benefits early for yourself. So with that, Brian, let's go back and talk now about some other risks that we're facing as we go through this period. One of the other things I'm seeing right now, a lot of people concerned about is market risk. We've had a long run of pretty successful markets. What are your thoughts there? And are there some things people can do to protect themselves?
Yeah, I think that's a good point. So there's always market risk, right? Regardless of if we're in the 80s or the 90s or well, I guess the 90s, there was no market risk. It just went straight up and never looked backwards, right? But starting in 2000 with the technology bubble bursting and a 3-year negative market, and then only a handful of years later did we see the great crash of '08. So I think a lot of us on the call and probably a lot of our clients are pretty open and cognizant of the fact that they're going to get hit. And they're going to get hit hard at some point. They just don't know when. And like you said, we're now like 13 years into this recovery from '08, and it doesn't show any sign of breaking. And the market almost seems to be in Alice in Wonderland, and we live in reality. But the market lives in a different world. Things that happen. I mean, coronavirus and a global shutdown and a pandemic and people losing businesses all over the place and not being able to even go to work to run their companies, you would think the market would have responded to that. And it didn't. It only did it for about 6 weeks, and then it turned around and went up as if coronavirus was cured. All businesses were reopened full. Everyone went back to school and life was good. That's the way the market reacted. So I think, number one, it's important that we all realize there's a dramatic disconnection between reality that we all know as financial experts and the market. The market lives in its own world. So how do we protect people against something that is not connected to reality? And there is actually a couple ways that we do that. We go back to, rather than trying to predict the market, rather than having a strong opinion on whether we think it's going to go up or down, we go back to basic financial planning formulas to make sure that a certain percentage of our clients' assets are not in the crosshairs of that market when it crashes. And we could wake up tomorrow and see the market down 15% and the beginning of a 50% drop over the next 5 or 6 weeks easily. And none of us on this call would be shocked, right? Would you agree?
Right.
Nobody would
completely agree.
Yeah, we'd all go, finally, it's about time it happened, right? Like we were wondering when it was going to happen. So the way that we deal with this risk is, rather than trying to predict the market, rather than trying to figure out when the next crash is going to be, rather than even doing traditional Graham and Dodd valuations on the market to say, is it too expensive? Is it too cheap? We just use some basic formulas. And the formula that I really like is one that I was taught years ago by a financial planning mentor of mine. And basically he said, the easiest way to do it is just take your client's age and turn it into a percentage. And that percentage, in a perfect world, should be the percentage that has absolutely no chance of losing any money. So, and the rest of it, shoot for the fences. Let them be as growth oriented as they want to, let them be in the market, let them buy whatever they're buying. So you have a 60-year-old client They got $1 million of liquid investable capital. I'm not talking about their primary residence or businesses that have a certain valuation. I'm not counting that as part of the pie. I'm just saying, just take the liquid investable assets, IRAs, 401ks, stocks, bonds, mutual funds, whatever. And for that 60-year-old, we would, as planners, like to see 60% of that money in things that absolutely cannot lose any money when the market crashes. And then let the other 40% ride, and hopefully this unexplainable bull market continues to go up. And we got 40% on the table that's going to really do well, and we have 60% that we can't lose any money.
People, you need to understand, as Brian talks about this too, that it exists out there. I think many people don't think that they can get an investment that can go up enough to outpace inflation, but yet be secure enough that you don't go down during a down market. In fact, one of my clients, I shared this story on some of our platforms, but I've got a client that's got over $1 million, Brian, over $1 million in a bank account. He's completely adverse to risk. I've talked to him about doing various things. He says, look, I can't invest in the market. I can't do anything else with this money. So he leaves it setting at Wells Fargo. For the last 5 years, he's had that money there. Any guesses, Brian, how much he's made on that $1 million over the last 5 years?
It's 5 years in a bank account? I'm going to say zero. He got a toaster, though. I think he got a toaster.
Yeah, it was a little higher than that. It was almost enough to buy dinner for the two of us at a nice restaurant. He got $85 per year out of that. So less than $500 over a 5-year period. Well, inflation, even at a 3% rate, he'd lost $150,000 of value over that period of time. So it's like, how in the world can you think that you're being safe and secure when you've got your money stowed away? And this is something that I tell all of you here on the show. If you've got your money in the bank making no interest, if you got it in your mattress and you're safe wherever because you want to protect it, there are options out there to allow you to get a much bigger upside and not have to worry about those down markets.
Yeah, you bring up a good point too, because a lot of times, all of us are in the business of protection, right? Our clients come to us not to get rich in a Vegas style stock market. They're looking for us to protect them against taxes, principal loss, estate planning issues, long-term care, whatever it might be. And when you think about trying to protect someone, usually to protect a client, you can protect them. Let's just use U.S. government treasury bonds as an example. I can go out and buy $1 million worth of U.S. treasury bonds that I can get paid a whopping 1% per year for the next decade, but I'm pretty super protected, full faith and credit of the entire U.S. government. I'm good. Right? Problem is, I'm making 1%, and I'm tying my money up for 10 years. Now, it's not to say I can't sell that treasury bond early before maturity, but if interest rates have moved up at all while I held on to that bond, I'm going to lose some of my principal when I try to sell that bond, right? So that's always been the challenge, is I have to give away return in order to be able to protect against risk. So there's a couple of different ways, and maybe on our next time that we get together, just looking at the clock, there's a couple different ways that we can accomplish a couple things at the same time. Number one, we can have something that has a full principal protection. It is absolutely impossible for it to lose any money. Number two, it actually has some liquidity in order to get at the money if you needed it, even in the earlier years. It's not 100% liquid in a moment's notice, but there is some liquidity within it. The rate of return on these guaranteed type investments, they can range anywhere between 4 and 7% per year. Now, if you're using that as a bond alternative, you are instantly rock star status with your client. If you can buy anything that's a bond alternative between 4 and 7%, they're going to have to buy junk bonds to get 3%, 3.5%. If we can get 4 to 7 with something that has no risk of bankruptcy or going under, that is really just, we really love that particular thing. And I got to a point about 10 years ago where, as my bonds started maturing in all my portfolios across the country that I manage, because I was managing individual bonds, we were not replacing those bonds because the rates were so much lower than the rate we locked in before the bond matured. So maybe another time we can get into some of those principal protection ideas.
I hope we can, because it is a part of the planning that we do. It's part of the risk reduction process that we go through. And what we find is that people think they can outperform what we're putting together, that they can get people into a better retirement by using traditional planning. And what we find is that's not the case.
Mm.
That time over time over time, the structure we put together is going to beat the other advisor because we're eliminating those risks. We're putting you in things that we don't have to worry about all these other things popping in. One of the other things we didn't get to today, long-term care. I wish we had time to talk about it. We'll talk about it on a future webinar podcast, this live event. There will be many opportunities for you to learn about it, but long-term care is another big issue that we're dealing with. Now, before we wrap up today, I do want to pop up one picture here. It's a little grainy. It looks like on my screen. I don't know if it is on yours as well, but wanted to let you know of a class that we're holding. We've talked about this here during our live events before, but it's the Changing World of Retirement. Now, we do have one this Friday, but unfortunately it is filled. You're not going to be able to get into this class, but if you'll go to our website and look on there, you'll be able to see upcoming classes where you can get in, take this 4-hour class. Now, you don't have to be a CPA to participate or an EA, but if you are, we do offer CPE credits for that 4-hour class. But it's a great deep dive class where you're going to get educated on all the various concepts that we not only talk about and answer questions to here, but that I talk about through all my other webinars, podcasting, and everything we do. So with that, Brian, any parting words as we try to wrap things up here on your side?
Well, I think, I think we're all doing God's work. That's all I can say, and I say that with complete sincerity, that people, regardless of their level of wealth, whether they have $1 million or a $20 million net worth, their fears, their concerns, their stresses are very, very similar. And I got to say, after more than 3 decades of doing this, I'm here just to see that look of relief and gratitude that I see from clients after they go from just not knowing if the future is going to be something that's going to work out well, to really being able to lay their head on a pillow at night and go, wow, I'm set. Brian and Dave have me covered, and this plan, I believe it's accurate, it's true, and I can just go on about my life and enjoy my kids and my grandkids and my business and my career and whatever. So I think all of us on this call as financial professionals, we really are doing some very important work out there. More than ever, people need us. And, I just think it's great. I'm just blessed to be here.
Thank you very much, Brian. And I can't agree with that more as we look to the future, and understand too, it doesn't matter what level of wealth you're at. You want to take care of it. You want to protect it. If you're someone now that Social Security is your only source of income, yeah, there may not be a lot we can do for you. You're going to get that government check every month, and that's going to be your retirement. But if you've got other assets out there, it's our job to put plans together. Many times in my webinars, we use fairly large numbers to show our samples and our analysis, but it doesn't have to be that way. You're faced with the same problems. And oftentimes those who make less money have a bigger problem, because if you do have a risk or a consequence of one of these events that we're trying to eliminate the risk from, it's going to have a far more impact on your lifestyle and your retirement than someone that's got millions and millions of dollars of assets that can go into another pool to be able to reduce that. So that's our show for today. Please join us again next week, where we're happy to answer questions. CR will be back next week, so you'll get him to run the show. Does such a better job than I do, but we'll have him back with us. Brian, thanks for being here. Look forward to seeing you later today, I guess, on a follow-up meeting.
Yep. We'll see you later. And thanks for having me.
You bet. Take care, everyone. See you soon.